Hello, and welcome to the Invest with Carl podcast. I'm Jamie Effenberg, your host and a member of the Carl team. And today we are speaking with Alex Shea. And Alex, we've had Alex on the show before. He is actually he's on the team that evaluates Carl hedge funds or prospective hedge funds for through the whole due diligence process before they are accepted onto the platform. But today, Alex is going to be talking more about investing in hedge funds and what a diversified hedge fund portfolio can do for an investor's overall portfolio. Alex has a background in banking and portfolio management, while he spent a portion of his career evaluating and allocating to quantitative hedge funds. He's a CFA charter holder, and we would like to welcome him to the show. Welcome aboard, Alex.
Thanks a lot, Jamie. It's great to be on again. Great to chat with you. Looking forward to it today.
Yeah, it's great to have you. So I talk to a lot of investors, and I know that many of them have never reviewed hedge funds before. And that makes perfect sense because we're essentially opening up hedge funds, this new investment type, to retail accredited investors. And since that's never happened before, this group of investors has never looked or reviewed hedge funds before. So it makes sense that they wouldn't quite know, exactly what are they looking at and how do they use these investments. These folks, they haven't had tens of millions of dollars to invest, but at this point they may have tens of thousands or hundreds of thousands to invest. And you're one of the first folks who evaluate Carl hedge funds, right? You take a look at them and you really know a quality, we won't say good or bad, but a quality fund, whether they're structured well, they have a good strategy as far as the evaluation of that goes. You know what you're looking for. So give us a sense of what you're looking for on the performance side, less on the operational side, but on the performance side of a fund.
I think, that's a great question, Jamie. The first thing that I look for is I am actually looking at what is the investor looking for? What's their purpose? Now, on the institutional side, where I used to sit on that desk, they're looking for, everyone talks about risk-adjusted return, and I can talk about that in a little bit, but their goal was more preservation of assets. And, they were invested in other more, let's call it complicated investments. But for our intents and purposes, I think it's a pretty safe statement to make that most of our investors are long S&P 500 or some way, shape, or form of that, or invested in the general broader equity markets. Maybe they got some crypto, or maybe they have some GameStop because they like to dabble in and mess with that stuff. And so broadly speaking, I would bet good money that most of our investors have a good, healthy amount of exposure to equity markets. And so that's where our investors have our product has a real value add as a diversification point to that long S&P 500. Let's just call S&P 500 as equity market exposure. And so with that in mind, when I am looking at a manager, looking at the risk and return profile, I'm thinking about the end investor in mind. Okay, well, is there a benefit to this? They're paying higher fees, but if it's just going to have the same return profile as the S&P 500, what's the benefit? And so that's the first thing I'm looking at now for our investors. So with that said, what does that mean? Okay, well, firstly, does the portfolio provide some kind of, I want to tread lightly here, but does it provide some kind of protection or some kind of offset or compensating performance when the S&P is performing poorly, or the general broader market's performing poorly?
Hedge, the whole hedge position.
Yes, but the reason why I'm treading lightly there is because if we're thinking about a hedge, there's actually an intentional positioning there. Whereas within your portfolio construction, if you actually are piecing your portfolation together such that it naturally, you don't have to artificially put in a hedge, it naturally is.
So just being uncorrelated, yes. Being uncorrelated in and of itself can be the quote sort of the hedge, even though they're not deliberately hedging the market. I see what you're saying.
Exactly. Yep. And so that's how I'm evaluating many of our hedge funds right now when I'm looking at their performance. Now they could do very well. They could be highly correlated with S&P markets. When S&P goes up 5%, the hedge fund goes up 10%, in any given quarter. So that's correlation. But if the performance truly justifies the fees, you're paying higher fees to get that 10% performance. But if it justifies it, then yeah, great. Let's offer it on our platform because it is a net benefit to our investors as well.
I don't think we have any quite like that yet, do we? Where
I don't think so.
We're mostly uncorrelated right now. Yeah,
we are, and we'll dive into that. But I think that's more of a kind of 30,000 foot view of, well, that's why we would offer a manager that perhaps trades just S&P 500 futures. Like, well, why the heck would you do that? But anyway, kind of going back before I take us on too many rabbit trails. Performance with return and risk. So something that we talk about, return is pretty obvious. You make 10%, you make 15%, that's a return. But the price you pay is typically equated with risk. Right. Risk in other ways is volatility, but what everyone really cares about is, downside volatility. So what that means is, well, on average, yeah, exactly. Yeah, I don't care if you have great volatility going upwards, great, but I don't care about that. I just care about how much money you're going to lose on average,
right?
Over a 1 year, 2 year track, 2 year span. And so let's use some examples. With the S&P 500, typically, historically, we're looking at a 15% annualized volatility, meaning over the long haul. We'll look at 3 years, 5 years, 10 years, heck, even decades.
It'll level out to about 50.
Yeah, yep. Exactly. Some years will be higher, some years will be lower. And so it's thinking about volatility. It's also the way that you get there. You go from $50 to $100. Are you doing 50 down to 25, back up to 75, then down to 60, and then up to 100? That's extreme volatility. Little volatility is you start at 50, and then you kind of go to 51, then 53, and then 52, and then you just what we also call like scaling the wall of worry. You just kind of eke your way up there. But that people like that because it's stomaching the volatility. Even I traded options for fun, and that was just not fun for me personally because I can't sleep at night knowing that there's so many swings.
Right.
I'm losing money, but I have the possibility of making all that money. And so that's where it all goes down to this. Essentially, how do we reduce volatility in our investors' ending portfolio?
Right.
And so that's where this diversification really comes out to. That's where I feel that we at Carl have really created a product that can help people sleep better at night right. Because they know that they're not just having full exposure to the S&P 500 and going with the right. swings
and or anything else. All of the swings. Yeah. I want to make sure everyone heard you that's the majority of our product is managing that risk side and making sure we have the strategies that we choose have quality intended risk controls, right?
Correct.
With the gains that they're getting. We talk about, we still have investors and we don't have a product for them yet, but I want to just mention that we're still open to a product that has really intense gains, that the risk profile isn't as sort of buttoned up as the strategies was selected to date. We haven't found one that we would love to give to them yet. So even Alex is not entirely opposed to this. A strong gain position is great, uncorrelated, and you might take on more risk for that, but we haven't seen one that we love yet. So we'll keep looking for you all. But so you're reviewing individual hedge funds and their own performance, right? Because that's what you evaluate when a fund comes in. You're looking at that one fund and saying, do we want this on the Carl platform? Does it go past our bar of quality? Does it meet our bar of quality of just a good hedge fund? I say this almost every program now, but we're the first to admit that there are a lot of bad hedge funds out there, and this is why Alex and the team exist. To at least say we know we have a standard and you got to get above that, right? So you're reviewing individual funds and their individual performance. And so what we're talking about on this program is this episode is what does it look like when you start to think about creating a portfolio of hedge funds, even an investor in Carl who has a low, they're in the tens of thousands, they can diversify even the minimum of Carl investment. They can diversify amongst multiple funds. How does that impact that portfolio and what you just talked about, their risk versus their gain? What can it do for their overall portfolio? If they make a sort of what we, in the hedge fund world, this is called a fund of funds. What does it look like?
Well, that's a great question, Jamie. I think the first benefit is that Carl provides is access. With $20,000, immediately right off the bat, you can allocate to 5 different hedge funds, and that is unheard of with $20,000. With $20,000, you also get access to 5 different well-vetted research strategies that provide uncorrelated returns relative to the S&P 500. And you get access to different strategies that are, for example, we have one that is commodity specific. We have one that does trend following for the US market, which makes more concentrated bets. We have one that is long equity markets, but has industry and tilts and sector focuses where there's specialties. So there's a benefit in terms of getting access to managers who would otherwise have higher hurdles. For example, on average, you're looking at $250, $500, or $1 million as the minimum threshold to get into a single manager. You also get access to strategies that are able to provide you with diversification benefits from your main portfolio. I keep reiterating this because it provides a lower volatility to your existing portfolio. And because with the lower volatility, you are achieving, let's say, the way that we view it is for every 1 unit of risk volatility, you get 1.5% of return. So what I was referring to before that I would hit on again, risk return ratio. Return is on top, risk is in the denominator. So for every 1 unit of risk, or that's your cost, you're getting 1.5 of return. And there are certain ratios that we like in the industry. On average, the S&P is approximately, for every 1 unit of risk, you're looking at 0.5, 0.7 unit of return. With our hedge fund managers, one of the minimum thresholds we look at is over the long haul, we want 1.2 units of return to
so almost double.
1 unit, correct, to 1 unit of risk.
Okay. So if I'm hearing you, if I'm hearing you right, if I'm getting this right, one step, you're heavy, right? You have a portfolio that's heavy in equities. And just for our investors, equities, stocks, and S&P are all it's the stock market at this point in general, common markets, right? So you're heavy in equities, and that means you're going to swing up and down as the equities do. And we've been in a pretty strong equities market for a while now. There's a lot of conjecture about when it's going down. Everyone knows that eventually it has to, but it's more about when. Is it coming soon, or do we have another year? What's going to happen? But eventually it will. And if you're heavy in that, then the whole portfolio goes with it. And so what you're saying is not only can you go into one hedge fund and get your uncorrelated diversification, you bring down the volatility, basically be putting up less risk for a similar gain, sometimes higher, sometimes near the S&P. So if we put more than one hedge fund together, we're actually sort of doubling down on reducing risk and maintaining a gain profile. And, goal being it would be at least, time to time above. You might be able to beat the market. But you're taking on less risk to do it.
Exactly.
If I'm hearing
exactly.
Okay.
Exactly. Yep, that is right. And another benefit to round out the answer to that question is we didn't talk about when those returns occurred, because that's an important factor. And we never want to say that our portfolio, the Carl portfolio, is portfolio insurance because that's an entirely different product. It's not insurance, but the way that the portfolio with our underlying managers is constructed is that they are invested in securities that tend to make money while the broader market is losing money, or their strategies tend to be positioned. So one big proof is in the pudding comment I'd make is, well, when COVID hit February, March, you saw equity markets hit a bear market, minus 20%. And our portfolio over that same period, we're looking at, let me take a quick look, up about 4% in February and up 17 in March of 2020.
Yeah, let's take a look at that diversified Carl portfolio for 2020 and 2021. I think that's what you're looking at there, right?
Yes. I may have jumped the gun there. So let's
do that.
Yeah. Okay. So the diversified Carl portfolio is our 5 existing managers, just to kind of give you some criteria. We went back, we're using live trading data back to January 2020. That's when it all started. And we equal weighted the 5 managers. So a 20% allocation to each one of them.
Yeah. So, and we can see, hopefully we're able to show the graph during this. We don't hit any regulations or lawyers. But if we show the graph for that, what happened was the S&P goes down during that February and March 2020, and the Carl portfolio was able to maintain, right? And actually,
correct.
We do have a tail hedger in our portfolio, and it did very well during that time. But even looking at it over the period, what are you seeing for these 2 years with the Carl portfolio?
I'm seeing strong performance, and especially in 2020, our portfolio was up just under 44% for the year, having equal weight to these 5 strategies, which is great. But any Joe Schmo can just be long equities or 2x equities and then get that same kind of return. But the best part was I'm looking at the correlation to the S&P 500. That metric is very important to me, and that is over the last year and a half has been minus 0.4. What that means to me is that the returns within our Carl portfolio are not as a result of just being long S&P 500
in the market.
So they are in the market, in the broader equities market. And so our managers are finding different sources of achieving alpha, extracting that alpha, and delivering that performance to our investors. And especially when it counted. I mean, how awesome would it have been if your portfolio was invested in the Carl portfolio February, March of last year, and you're seeing your S&Ps coming down, into the bear market territory, but you're having that offset from the Carl portfolio.
Right. You feel like you have someplace else to go, right? You're like,
exactly. Or it cushions the blow. And while its past performance is never indicative of future results,
thank you.
I just have to say that for our lawyers. What we do is we vet managers who are best positioned to capitalize on downturns or pullbacks or bear markets in the market, as an example, especially our tail hedgers, we can call them, that do want to do that, so that it can, in that case, reduce the volatility of your portfolio. So for February, March, if you're, instead of you being down minus 20%, just throwing numbers out there, you may be down minus 10%, minus 5% as a result. And it pads that loss. It reduces that loss and therefore reduces that volatility in your portfolio.
Right. And then the portfolio continued to grow and do well, even as the S&P, as I said previously, S&P is pretty strong right now. So the Carl portfolio continued to do well, even as the S&P is strong. So the Carl portfolio obviously did well in that February, March 2020 period. We talk about it a lot, and that makes sense because we do have a tail hedger in the portfolio, and overall they're uncorrelated, so they could maintain what they were, where they were, or just stay flat when the S&P really had a tough time, which you're about to see, because I'm going to have, I think we can not get away. I do not mean that at all, my regulators. Let's just mention 1 or 2 statistics, because I'd like to highlight lightly what the risk that was taken during this period, the 2020 2021 to date. What was the risk in the Carl portfolio look like versus the risk in just being in the S&P? Can you give us just a little taste of what that was?
Yeah, of course. So looking back to all of 2020 and year to date for 2021, that would be through the end of May. Largest single monthly loss for the Carl portfolio, minus 2.43%. Largest monthly loss for the S&P 500 over the same period, minus 12.5%.
Right.
Recovery period. Oh, yeah. Go ahead.
No,
recovery period. There is no lag. We are actually just crossing wires. Recovery period, how long it took for the Carl portfolio to recover from that minus 2.43, 4 days. Recovery period for the S&P, and that's minus 12.5%, 103 days. And just so you know, that is one of the, anecdotally speaking, that was one of the fastest and sharpest S&P 500 recoveries in terms of bouncing back from a bear market in history. And still, even then, although it's not an apples to apples comparison because the loss wasn't as drastic on the Carl portfolio side, that's the point. Why do you want to have a good recovery period if you've never had the loss in the first place, that drastic of a loss in the first place? So,
right. Yeah. I mean, it's very interesting. And I can definitely say when you look at individual Carl funds, the stats are not always that strong. There's obviously some power or strength in putting them together. Obviously one can perform while the other maybe is not as high on a given period, or in a recovery. But overall, it doesn't take down the whole diversified Carl portfolio clearly over a period. At least that's what I've noticed, because I have to look at, I talk to a lot of investors. I look at each Carl strategy individually. And I don't as often look at these diversified portfolio samples. And it's really, really interesting data. It is, I also find it profound, like you're saying that 103 days on the S&P was a fast turnaround.
Very fast. Well, that's for the 12.5%. It's for a single month. The actual drawdown was 34% for the S&P 500 last year. That's you're crossing months there. That was the fastest recovery in history from that sharp of a drawdown.
Yeah, and that's why we say it's still going strong, right? I mean, it was a pretty quick.
Yeah. Thank you, Fed.
A tough bump, but a quick return to growing. And we'll see how long it keeps going. So obviously what you're saying is, as much as you look at individual Carl portfolios and look, are they uncorrelated? Can they give you something different that you don't already have? And are they going to have gains, right? That makes sense with the fees involved. And then I just feel like we talk about this frequently, and we know our investors are getting the message with us that these types of investments can just reduce that risk while maintaining those higher level gains. And there's not a lot of investments out there like that, are there? Are you, familiar with, like, where else can you get that kind of investment diversification? There's not a ton. I mean, obviously you're with Carl, and so we're going to have a perspective on these investments going forward, but and I'll highlight that. But seeing as these weren't available before, how do you see investors using hedge funds, regular retail accredited investors using hedge funds in their portfolio, moving forward now that it's available, particularly in a diversified hedge fund portfolio portion of their portfolio?
I see this as diversification benefit 100% of the way. Access to what has previously been inaccessible to retail accredited investors, unless you got $1 million to boot, and that's only, or it reflects just a portion of your investable assets. But most importantly, you're getting access to the top of the top managers who are doing R&D work, looking for new alpha sources, new opportunities in the market, and aggregating these resources to be able to, and providing, used through economies of scale, providing these returns because they're having access to, who wants to pay $50,000 for microstructure trading data, and what kind of average retail credit investor has access to that. But by pooling these assets, that's what hedge funds do. They're able to purchase these expensive data sets and run through it using machine learning or using their algorithms and trading with using emotionless systems to trade and capitalize on the emotional market. That's my personal belief.
I like that.
That is the huge benefit to our investors, that having access and the access.
Yeah, and I mean, I think a lot. Did you hit the access enough?
Did I hit access yet?
Yeah, I mean, I think, diversification of a portfolio, obviously, statistically, you've said white papers, et cetera, they just lift a portfolio, right? The more you can diversify into a quality investment, you're going to lift portfolio. And will this become a new standard that people can get into these types of investments with real pros who have been doing this a really long time, and they have access to data and systems that, a regular retail accredited investor isn't going to get solo.
Right.
So, I'm big on being with the pros. I don't like to dig into the data myself. I don't like to scour and go through companies, even though I can professionally. I'm trained to do it, but I don't enjoy it. So so we're sort of like you with the options trading, right? It's like, this is a little much. Yeah. So
absolutely.
Yeah, thank you so much for chatting today. Thank you for talking about, a diversified Carl portfolio. We haven't really talked about that specifically yet. And on the risk side, I really encourage our investors to create a diversified portfolio on the Carl mobile app and take a look at that risk profile. I was actually surprised by some of those statistics. It's a lot less risk. And the gains are it's how you put your portfolio together and what you're looking for. There are some, configurations that you can beat the market, and overall, at least you'll be close to a similar return, regardless, because all of our investments are historically, they're strong on the gain side. Obviously, you have to take a look and decide for yourself what they will do in the future. And we will see you next time. Get on the mobile app, create a diversified portfolio, and we'll see you next time. Thanks so much. Bye-bye.
All right. Thanks.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.